let's take a look at what's going on the ground, and for SMEs, home buyers. Anthony Lundell joining us from Equilibria Finance. Anthony, good to see you.
Great to be here.
All right, I'm trying to remember what your call was last time we spoke about what the RBA was going to do. I'm not going to put you on the spot, but what was your reaction, and what is the word on the ground just as far as borrowers are concerned?
Well, I can't sit here and say that I forecast a 50 basis point increase, and I don't think anyone was expecting that. But I certainly think the RBA has shifted its sentiment around how it's going to attack inflation. We all knew rates were going to go up. I guess the question was by how much. And I think what we're seeing is the RBA has absolutely shifted its intent to chase that inflation. It's a real change in language, because obviously they're waiting around the wages growth to come. And there's a lot of things outside our control that are still impacting inflation, supply chain issues, cost of oil. So it's interesting times ahead. As you just hinted at, the major banks are all at a 3-month low in terms of the stock market, and a lot of home buyers they're already facing a lot of affordability constraints, and that's going to mainly impact owner-occupier home buyers. SMEs, the cost of doing business is going up wherever they look. So that's some interesting conversations we're having with our small businesses as well, albeit there's still pretty good confidence out there around business sentiment, but consumer sentiment might start impacting that in the months ahead.
All right, so I mean, it's not good news then for lenders, is it? If business, you're seeing it drying up significantly as both businesses and potential home buyers think twice now, given where the likely pace or where those rates are likely to go.
I think what we're going to see, and what we're started to see, is home buyers are dropping back on the market. They're down about 2.2% on last year. Investors is what are coming back into the market. Investors are up 48% from 12 months ago in terms of activity with the lenders. The reasons for that is, for an investor, cash is still relatively cheap compared to the rental market, which is booming. So there's a little bit of inflationary protection for investors. They're coming back in the market.
As they seek that yield, which they're going to get, particularly as rents rise.
That's right. The investors are seeing rising rents, a tight market for rents, and the cost of money for an investor is still pretty cheap, and the stock market's been not having its best patch. So for investors, they're sort of coming back in the market. As I said, they're 48% up on last year. For small businesses, it hasn't had a lot of impact to date. Small businesses they're looking to invest again. They're borrowing funds for investment. We're still getting some really good rates for small businesses. I think what might come through and affect small businesses maybe if consumer sentiment gets impacted with cost of living pressures, inflationary pressures. We're also talking about a minimum wage rise, which might also have some flow on through to inflation as well.
Yeah, I mean, you've just mentioned that wages. Obviously, that is potentially a large impost for businesses going forward if we're seeing those increases with, of course, the federal government having recommended a 5.1% minimum wage rise. Energy, those energy costs, I mean, that is a big hit to business at the moment. Not just, well, it's fuel as well as obviously, the price of gas at the moment too. And then you combine that with where interest rates are going. So does that mean, are we likely to see, particularly as far as capex and light, pullback, do you think?
Yeah, cost of business is going up. You've mentioned a lot of those factors, and there's the supply chain issues as well impacting the construction industry. So yeah, I think it's going to be interesting to see. It's hard to crystal ball that one, because I think there's a buoyancy in the economy as well with small business. We've got a lot of customers coming to us at the moment looking at investment, looking at funding investment through getting additional cash flow. But it will be interesting to see the flow-on effect if the inflation keeps getting away. The thing that our inflation's still lower than a lot of other economies. What's really affecting us is the speed of its growth, and that's what the RBA is trying to rein in. But I think the government's also got a role in this. There's things outside monetary policy that are potentially impacting inflation. You've just raised one there, the potential wages growth to match inflationary. There's supply chain issues that are outside the brief of the RBA and monetary policy. So I think the government as well is going to have to be looking at some of these things pretty closely. Energy costs, as you raised as well, and the flow on through to small business may actually ultimately come from a lot of pressures and affordability pressures and consumer sentiment.
We saw the majors and the minors moving as one, essentially passing on that rate hike in full. How competitive is the lending market at the moment? I mean, are there deals out there for borrowers?
Yeah, look, across the board, pretty much most providers have now passed on 50 basis points. Fixed rates have moved. There are still opportunities for homeowners to find a better deal. Start with your bank, talk to them about what they can do. But the ability to leverage a better deal off your bank is getting harder because rates are rising. So there are still competitive options out there. A lot of what we're seeing is there's a little bit of flux. Fixed rates have moved. For some borrowers, it doesn't make sense to fix. Variable rates are going up. The good thing is that a lot of borrowers are ahead on their payments. The other thing is we've got to keep our perspective. Rates are still relatively low. It's just that a lot of people have never seen these rate rises. And I think we're working towards probably the cash rate being 1.752% by the end of this calendar year. The RBA has finally given a bit of indication that that's where it's heading. There could be another 50 basis points on the radar next month, is what a lot of economists are forecasting. So I think the opportunity to refinance and restructure is getting more difficult, but it's case by case, and that's how we're approaching it.
Yeah, I mean, it's obviously going to be very difficult at the bottom end of the market for those new home buyers, particularly those that perhaps got in the last 6 months at the very top of the market.
Yeah,
when potentially you could fall into negative equity.
That's right. There's potential for the housing market has slowed. Investors are propping that up, in fairness, though. So while we're seeing the rate of growth slow, we're not seeing that negative equity yet. However, with interest rates set to go up another over another percentage point over the course of this calendar year, that will start flowing through to the housing market.
Yeah, that's the $1 million question, isn't it? Because I mean, I've seen so many forecasts of where property prices are likely to go to, as low as 25% lower.
Yeah.
Are you willing to give it a number, or is it just too many variables at this point?
Look, I'm willing to say that I don't believe we're going to see that. I think there's enough activity, there's enough, it's creating other opportunities. There's home buyers who weren't able to get into the market that might be on good jobs that were struggling with a deposit. The market's dropping, there's opportunities there, and there's investors that are now chasing some of those cheaper properties. We've still got a genuine supply and demand issue. And
I guess you've still got to factor in immigration and where that goes.
I was about to say that the borders are opening up.
If the new government decides to open it up and try and catch up from the lack of immigration over the past 2 years.
So the rate of growth is slowing, no doubt about it, but I don't see a 15-20% property crash and that sort of negative equity position that maybe some economists have talked about.